back to Random Gleanings. He is Jesse. I am Chris. Jesse, we're going to talk about diversification if it still works. You pulled some charts on where we are from job opening standpoint, though, first.
Yeah, so, you can see the purple line is the job opening numbers, and it has come down dramatically from the heights of 2022, and you've seen a little bit of an uptick in unemployment numbers.
Which equates to 6.6 million people that are currently seeking work. So that's about 1.2, whereas it was over 2 to 1 job openings versus unemployed people at
That is correct.
Right?
At the extreme, that's where it was, and so here you can see that that's been cut in half, even though the chart's showing percentage of unemployment versus numbers of people. But all this to say is that's coming more in line.
Yeah, which
means
is good.
It is good. It's an indication of a tighter labor market, but it's certainly not tight as you can see at other times in history.
So what's interesting, though, and this is going to be super interesting, is, and this is from the Twitter, the next chart, corporate transcript mentions, this is like earnings calls, the mention of, quote, operational efficiency, which many would take to mean potential layoffs in the future.
Think, yes, that is what I've heard as well, is that's being interpreted as as layoffs or maybe not hiring or whatever. But
and that number, that number, as you can see in the chart, starting to rise. I remember Liz Ann Saunders at the beginning of the year, her annual report discussed the notion of rolling recessions and, some things doing well while other things not doing so well. Tech obviously now is kind of in its heyday, whereas in 2022, they went through a layoff period.
They did. And so I think what we are taking away from this right now is, if the economy interprets itself through the market, which is not always perfect, but markets are responding positively to the idea of operational efficiencies.
That's right.
And one would suggest history would tell the tale of, at some point, if layoffs occur broadly across the economy, it will start to hurt businesses. But at this point, growth is strong and earnings are persistent.
Well, yes and no. No, in that if sales remain constant and yet they do layoffs, then ultimately that increases the bottom line.
No, that's what I'm saying, is that right now that's how the stocks are participating or are doing very well.
And interpreting.
In doing that, that's right. I would think that there's a threshold at which enough people have been laid off that sales decline.
Yeah, no, I agree with that.
And we just haven't hit that right now.
So let's look at the next chart. So this is Fed funds versus core personal consumption expenditures, which is one of the Fed's darlings. And you can see the Fed in the past, 2000, 2007, had a habit of kind of holding interest rates up when that PCE number started down kind of hard, and those gray bars are recessions. So the Fed is, we entered the year, the Fed said they were going to cut rates 3 times. They have cut none through mid-June. Now they project 1 rate cut. The big question is going to be, ultimately, does everything hold steady through this time period? There's really no reason to think it won't.
There's not. Again, what I look at when I see this is that looks like a restrictive number, 5.25 on the Fed funds rate versus a 2.75, core PCE. But again, stocks aren't telling that story right now. Don't have there's no imminent gray bar that's going to appear on the right side of this chart.
I think so let's segue into markets and kind of talk about what's happening in the markets. First off, this is a chart from our friends at Y Charts. I just think this is a fantastic chart. This is a chart that goes through rolling returns. And at the very top, you've got 20-year price returns on a rolling basis. And there are a lot of comparisons made to 2000 right now. In fact, we'll mention 2000 a few times in subsequent slides here. But in this first chart, the 20-year average annual return for stocks hit 14.38% in 2000. Today, it's 7.75,
which is just over the average for a 20-year rolling period of just at 7. But
definitely not out of control.
Yeah, definitely not way way overheated.
Yeah, I mean, you look at the 10-year in 2000, 16.75, 10.6 is where we stand currently on the 10-year. 5-year, the high was 26%. 5-year average annual return is currently 12.85 on the S&P. I mean, it's not that.
No, and let me just real quick, because I know these things can be hard to see on a phone or on a computer screen for the time that they're up. Hit us up at info@ProPlan Wealth if you want to look at this more closely, because like Chris said, this is a great chart that just kind of spells out things are not just out of whack right here.
But what is kind of out of whack, and this gets to the notion of does diversification work or not? The first chart here are U.S. large caps versus small companies. You're now at the highest ratio, the comparison. Larges have outperformed smalls in a massive way, the highest since April of 2000.
Yeah, so as this chart is going up, the black line's going up, it says larger companies are outperforming smaller companies. If it's going down, it's the vice versa of that situation.
Right, so large companies have been outperforming smaller companies.
They have been, and to your point, it's as extreme as it's been since 2000, at which point...
Let's look at the next chart.
At which point, small companies started to outperform large companies for an extended period of time.
Right. That's right. Okay. And then let's take growth. Let's take, the Magnificent Seven, the NVIDIAs, et cetera, of the world on artificial intelligence. Let's look at growth total return versus value total return. And value's the little bit more boring type stuff versus the more sexy stuff. So here, yet again, the highest since July of 2000, you've got large growth companies outperforming large value companies. And you can see back in the 2000s, why would you want to change, and own value now? Well,
leading up to the peak, all you would want is growth, and it'd be hard to abandon growth after you've been rewarded so well.
That's right. But let's look at 2000. Let's look at July 2000 through July of 2007, value versus growth. Oh, hey, look, number one, value has a positive return. That's number one.
That helps.
Yeah, it does. Number two is that Russell 1000 growth in that time period, a 7-year time period, had a negative return.
I did the math. That value was at 8.8% compounded average annual return versus a negative 4.4 compounded average annual return for those 7 years. So, that would point to some benefit of diversification.
It would.
Presumably a diversified portfolio held on to growth during that period, but you weren't getting walloped and losing a quarter of your portfolio value over those 7 years. Instead, you were actually still growing if those things were equally weighted.
Right. So let's look at another comparison. We talked about international not long ago. Here's the S&P versus the rest of the world from 1970 through June of 2024. You can see basically since 2008, it's been about a 3 standard deviation outperformance of U.S. versus non-U.S. in terms of stock performance.
I mean, that's wild, because ultimately what 3 standard deviations means is 99% of the time, numbers fall within those realms or closer to the median or the mean. And so
it's stretched about as far as it goes, you would think.
That's right. Yeah.
You would think.
I mean,
there's no guarantee,
yeah, that's right.
But
it
would
could
think.
continue in that direction, but one would think that eventually things, come back and there's some advantage to owning the international markets over U.S. for a period.
So next chart, I mean, NVIDIA, no question, has been the darling, and this is not hating on NVIDIA. This is just talking about diversification. I mean, why would you want to own anything other than NVIDIA? This is a 5-year chart. It's up 3,652% in that time period. Listen, if you've owned it the whole time, kudos to you.
Yeah,
that is fantastic.
Yep.
Thought we'd just do a comparison, and I'm sure we'll get a little bit of hate mail out of the comparison. But here is Tesla from June of 2019 through November 2021. And you can kind of see it up there. I'll circle it in the chart. 2,297% in that time period, the beginning of that 5-year time period. Okay. And here's the next, the remainder of that time period from November 2021 until yesterday. it's down 51%. So, I mean, the moral is you still have a 10-bagger. I mean, the stock's still up 1,100% in that time period, and that's fantastic. But things can get stretched and come back to earth.
I would venture a guess that what my experience has been in working both for myself and for others is I think my money is worth this now in Tesla, right? And while I started here and it got to way up here, if I'm back here, I've kind of forgotten that I only put this amount of money in. I was high watermarking is what we call it, high watermarking back up to that previous all-time high. And so it is at minimum an emotional kick in the teeth to take that walloping. So,
I mean, what I take from that is, you know what, diversification does matter, both at the company level as well as, look at it from an asset class standpoint. Last week, we talked about mid-value for 25 years being the best performer relative to the S&P. Now, not since, 2009. Right. I mean, the S&P's beaten it, no question. But at some point, some of these things are going to have some mean regression, right? Like you're gonna see some other things do okay too.
Yep.
Along the way.
Yep.
All right. So what are you watching?
How about instead of that this week? I just want to call to attention. Today is Tuesday, June the 18th. Tomorrow is June 19th, which for the two of us marks 4 years of being professional planning and wealth. So
yeah.
Congratulations to you. Thank you to you all for working with us over that time frame. It has been a real joy and blessing to my life to have done this and to have done it alongside you. So thanks.
Yeah, absolutely. And I agree and concur. It's an interesting time. Please do call on us if we can be of help to you. Please share this with a friend. I mean, listen, I'm telling you, there's some charts in here that are gold. I can't tell you which ones because I don't know. But at the end of the day, there are some other things that will participate at some point. Yeah. And it's very important to know that. It's why we stay diversified for client portfolios. It's why it matters to pay attention to what's going on. Yes, we're in a time period where there's some true change out there, and artificial intelligence may be that change, and it may be persistent. It may go straight. History says it doesn't usually go in a straight line, and you have to be aware of that. So, we'll continue forth, and that's
one
all.
One other thing to be aware of is if we're diversified in client portfolios, we're diversified in our own portfolios.
That's right,
because we eat our own cooking. So
that's right.
Again, thanks for listening. Hit subscribe, hit the bell, be notified when another post comes up, and we look forward to talking to you again next week. Thanks.